In 1988, Warren Buffett made a bold bet. He poured $1.3 billion into Coca-Cola stock, buying 400 million shares. Back then, the dividend was just 8 cents per share annually. Fast forward to today, the same stock now pays him over $700 million every single year in dividends. That's the mind-blowing 54% dividend yield on his original cost. He hasn't added to the position in decades. He just holds, collects, and lets the cash roll in. This is the magic of dividend growth investing. And yes, it's still possible today. With patience, the right picks, and time on your side, you too can build a portfolio that pays for your life. We are going to be leveraging one of the best free screeners out there, Finviz.com. Currently, we are on a homepage, and what we are going to click screener, and you can see there are different tabs: descriptive, fundamental, technical, news, ETF, and all. We're going to click all. There are a lot of different filters, but don't worry, I will walk you through all of them and explain which exactly do we need to use to find high quality dividend growth stocks. And after we filter out just a few high quality dividend growth stocks, I will show you the most common mistake dividend investors make when they are picking dividend stocks. Before we start looking for our dividend growth companies, you can see in our list we have 9,987 companies. And now let's begin. Let's start from the country. For the country, if you are investing in some particular country in European Union or in US or Canada, you can go ahead and filter by the country. Or if you are a global investor, you can just directly keep any. For our example, we'll go with United States of America. The next filter is market cap. For the market cap, we want to choose some bigger companies, because if the company is too small, the highest priority for this company is reinvest into its own business. But for bigger and established companies, they can already distribute some of the profits by dividends or share buybacks. So for us, I would prefer to go with something like large plus, which means the market cap for the company will be over $10 billion. Okay, very nice. The next two filters are company's valuation, price to earnings and forward price to earnings. The price to earnings is showing how much do we need to pay for every dollar of company's earnings in the last 12 months. But for forward price to earnings, this is looking into the future based on analyst estimates. I personally believe that forward price to earnings is even more important than price to earnings. That's what we're gonna use. We will choose under 30. Someone would argue that under 30 is a little bit expensive, but I just wanna make sure that we will not filter out high quality dividend growth stocks, which are trading a little bit more expensive comparing to the market, because they are still growing, because they have very strong moat. That's why we will go for under 30. The next one is PEG ratio. The PEG ratio is taking forward price to earnings and dividing that by company's growth. Usually I will go under 1.6, but the free version of Finviz does not allow us to choose a 1.5 or 1.6, so we will go under 2. The next filter is price to sales. We want to make sure that we are filtering out very expensive and overhyped companies, so we will go under 8 for the price to sales. The next filter, very important, is price to free cash flow. I will remind you that the company is paying dividends from the free cash flow, not from the net income, but from the free cash flow. Free cash flow is used for 3 different things: paying dividends, doing acquisitions, and doing share buybacks. So this is very important to understand. So for the price to free cash flow, we will also go under 30. Okay, very nice. Currently, you can already see that from almost 10,000 companies, only 125 companies left, and we did not finish yet. If you are enjoying video so far, please consider subscribing to the channel. On the channel, I do fundamental analysis. I run public YouTube portfolio. I do educational videos. If any of that interests you, please welcome to join. And we're moving forward to continue finding our dividend growth machines. For the next filter, we need to make sure that the company is actually growing, because if we want to find some company which will increase the dividends for 30 years, similar to what Coca-Cola did for Buffett investment, we need to make sure that the company is actually growing. So for the EPS growth past 5 years, we're gonna choose over 10%. 10%. And for the EPS growth next 5 years, we also want to make sure that the company will continue growing in the next 5 years. Of course, this is no guarantee because this is based on the analyst expectations, but at least currently analysts are positively considering the company's growth. So we also will go for over 10% for the EPS growth next 5 years. For the sales growth past 5 years, we will choose over 5% to make sure that the company is growing revenue faster than inflation. And finally, we arrived to the dividend yield. For the dividend yield, we will not go over 10% or 5% to find high yielding dividend stocks. Of course, we can do that if you are looking for these high yielding dividend stocks. But for our example, we will go for the positive to find companies which at least paying some dividends, and we want to make sure that this company will keep growing into the future, and over the next 30 years we have a chance to generate $700 million in dividend income. The next filter is return on equity. Return on equity is showing the company's profitability, how much profit company can generate from the money shareholders invested. For the return on equity, we would go for over 10%. The next filter, current ratio. Current ratio is a liquidity measurement which is showing the company's ability to pay its short-term obligations. It's calculated by dividing current assets by current liabilities. We will go over 1. The next one, we are going to make sure that the company is not over leveraged. So we will choose long-term debt to equity under 1. The next filter, very important, the company should be actually profitable, and not only profitable, the operating margin of the company should be high, which is showing the pricing power and moat. If the company can have a high gross margins, operating margins, it's showing the value propositions because competitors cannot build similar products and services to compete with the price. So which means that this company has pricing power. So for the operating margin, we would go over 20%, and for the net profit margin we will choose at least 10%, so we will go over 10%. The next filter is showing the company's ability to pay dividends. It's called payout ratio. Payout ratio is showing which percentage of the company's net income the company is paying as dividends. So for payout ratio we will go under 60. And now we have just 6 companies left. Let's see which companies do we got. Wow, this is quite well-known companies. We have Google here, GOOG and GOOGL is the same company. This is Google, is just 2 different ticker symbols. And then we have Lam Research, Meta Platforms, Merck, and RisMed. Now what we can do is click on a snapshot and we will get the details of the company, all the very important stuff we just filtered. Also the news, you can have a look of the recent news here and the chart of the company. And now let me show you the most common mistake dividend investors make when they are choosing dividend stocks. And I will show you this mistake using the example with Merck. Let me show you how to find out if company can afford paying dividends. So what we can do, we can go to finchat.io. We are looking for our company. We are looking for Merck. And after that, we go to financials, cash flow statement. What we are looking for is dividends paid, and here you can see common dividends paid, so we choose this one. And the next one we're gonna choose is free cash flow. Here you can see the section of free cash flow. We're also gonna choose free cash flow. And now you can see in 2024 financial year Merck paid $7.8 billion in dividends, and meanwhile it generated $18 billion in free cash flow, which means after paying dividends Merck has enough money to pay the debt, buy back shares, do acquisition, reinvest into the business and stuff like this, which means that this dividend is totally safe. But if the free cash flow would be $5 billion, this would mean that to continue paying and raising dividends, the company should take more debt, which is usually the red flag for dividend investors. Coming back to our high quality dividend growth stocks, the next step is to do fundamental analysis to find out if any of these companies deserve your investing dollar. I hope you enjoyed the video. If you did, please consider subscribing to the channel. If you are curious how I am doing fundamental analysis, please watch this video next. I recorded the video where I showed 7 simple steps how I do fundamental analysis with AI and increasing the efficiency of stock research significantly. I will see you there.